good afternoon. I'm Danny Ratliff here with Lance Roberts and Richard Rosso this afternoon. We appreciate you guys joining us. We are RIA Advisors, actually Clarity Financial doing business as RIA Advisors under the Securities and Exchange Act of 1940. We appreciate you guys being here today. Don't construe anything here as a recommendation. We've been getting a ton of questions about bonds. So this is going to be a little bit different format, a little bit more like a candid coffee if you guys have been logged into one of those on a Saturday. Pretty open. We're going to talk a lot about bonds, what's going on, the market, the economy, what the impact that has to you guys and your portfolios. Thank you guys so much. We know there's a ton of things you guys could be doing today, but we're going to jump right in. So Lance, one of the big things that we're hearing pretty consistently is, you look and see interest rates have been on the rise, yet they've come back down a bit. We're seeing them pop back up a little bit again. And people say, why bonds? Why would I hold this? And what we're finding is sometimes people don't even understand just the basics of it. So let's start at the very foundation of what a bond is and why you would use one, what the overall environment looks like longer term for an instrument like this.
Sure. So first of all, bonds are simply loans. That's all it is. So, Danny, if you go to your dad and you say, Dad, can I borrow $100,000 for a new house, whatever? And your dad says, sure, I'll loan it to you. There's a document usually written, and we call this a loan agreement in a lot of cases, but all a bond is basically a securitized loan agreement. It's just a loan agreement between a corporation, in most cases, and a lender. And that has been now put into a security that you can then buy on the open market. So it's simply just you're buying a loan of some sort. So Apple, as an example, they borrow money to do whatever they're going to do with it, pay a dividend or do stock buybacks, whatever. They issue out a bond to do that. Investors buy those bonds. So that's all you're doing, right? And so as opposed to an equity, which is buying a stake in a company, all a loan is basically you're loaning money to Apple or Microsoft or ExxonMobil or whoever it is. So, right, you're just making a loan to these companies. And as with all loans, there is a principal payment and an interest payment attached to that loan. And in the majority of cases, bonds do differ from one structure to another, but in the majority of cases, the principal is paid at maturity. So it's like a balloon note, and you get an interest payment along the way. It could be paid quarterly, could be paid monthly, semi-annually, annually, just depends on how the loan document is structured. But that's all it is. So there's nothing mythical or magic about bonds that is really, kind of the secret black box of anything. But there's a lot of different types. We talk about corporate bonds. We talk about treasury bonds. We talk about agency bonds. These are Freddie Mae, Fannie Mac, Ginnie Mae, which are the Government National Mortgage Association bonds. These are your home loans. And then there's all kinds of derivative loans out there, collateralized loan obligations, leverage loans. There's all kinds of flavors and structures in the bond market for different types of things. And we're only going to focus today on corporate bonds and treasury bonds for the most part, because those are the ones that we use most often. Those are the ones mostly available to you as an investor. And you can buy these directly from Schwab or Fidelity, wherever your custodian is. You basically call up the brokerage firm and say, hey, I want to buy a bond, and they will give you to the bond desk, and you'll say, I'd like to buy a bond, and I want to buy a bond that's 3 years to maturity and has a certain interest payment. And they'll tell you what they have available. Either they have some or they don't, and you can buy a bond and put it in your portfolio. It's not difficult, right? That's my whole point. It's very simple stuff. But now let's talk about specifically how a bond works and the benefit of a bond over a stock. And what we don't spend enough time on in the financial media is really talking about bonds. You may not know this, but the bond market is about 4 times the size of the stock market. But all we talk about is the stock market. But bonds are an instrument that have a lot of importance to the U.S. economy to a great degree. Credit is the lifeblood of the U.S. economy. Without credit, everything stops. And if you don't believe that's the case, all you have to do is go back to 2008, which is when Lehman Brothers failed. And at that point, when they filed for bankruptcy, all the lenders said, I'm not doing business with anyone because I don't trust, I don't know who's going to go out of business next. And what happened is that all the counterparties, and this is what we call counterparty risks now, and this all developed in 2008, nobody wanted to deal with anybody else on debt because nobody knew who was going to blow up. And when that occurred, the entire credit market shut down. Nobody could get a loan for anything, and the economy sunk very rapidly. Credit is incredibly important. Now, why would I want to own a bond versus a stock? Stocks go up a lot more, right? I mean, that's that's what we're told all the time anyway. And so I want to own stocks because I'm taking on risk and I'm expecting the stock market to go up and the stock is going to appreciate over time and I'm going to make more money. Would it surprise you to know that if you had owned treasury bonds in 2000, you actually outperformed the market until 2020? You actually made more money in bonds than you did in stocks over that 20-year period. And this is because of two things. There's one important factor about bonds that dwarf everything else when it comes to equities. When I buy an individual bond, the day that I buy it, I can calculate to the 100th of a cent the exact return I'm going to get on that bond in the future. That day. So as soon as I buy it, if I hold that bond to maturity, I can calculate to the penny exactly what my return will be during that holding period. I can't do that with an equity. So if I could build a portfolio today of individual bonds that were all yielding a certain yield, right? And I was happy with that yield, I could tell you to the penny exactly what the value of my portfolio would be when those bonds mature. Can't do that with equities. We're all taking risk with equities. And equities have unlimited upside. They also have finite downside to zero. So there's a risk to equities that I don't take on with bonds. Now, is there credit risk? Again, so we start talking about bonds. We also have to talk about the risk of bonds. There's all kinds of risk with bonds, right? There's credit risk. Company goes bankrupt and they don't pay you back. That's a risk. But that's why certain bonds have a higher yield than other bonds. And what yields calculate is the amount of risk you're taking by owning that bond. So if I'm buying a bond of a company that doesn't generate income, has a not so logical business plan, whatever it is, and they want to issue debt, they're gonna be required, because you as a lender would require a higher rate of return. And this is what we start talking about: high yield bonds, junk bonds, those type of things. These are companies that have a credit risk to them. They could default and not pay you back. And so that's why you get a higher rate for them. But you need to understand, and this is one thing we've lost over the last few years, is because of low interest rates and a lot of Fed interventions, people were chasing junk bonds because they were marketed as high yield, which was the Wall Street marketing term for these junk bonds. These are bonds that in a lot of cases are on the verge of bankruptcy, and they were marketed as high yield. And so you went out and bought them because you could get a 3% yield versus a 1% yield on US Treasury that is a guaranteed repayment. So there's things you need to know about bonds. We'll get into some more of that conversation today, in particular, as we talk about risk and allocation and what's going on with markets. But the important thing to know about bonds, and again, the most important thing is that when you own a bond, it doesn't matter what the price of the bond does from one day to 1 week to 1 month to a year from now. If interest rates, if I buy a bond today at 100 cents on the dollar and interest rates go up 20%, the value of my bond will go down in value by roughly 50% of the face value. And so like oh my gosh, I'm losing money, but you're not. Because the beautiful thing about the bond is that when it matures, you get 100 cents on the dollar back plus your interest payment. And of course, that doesn't happen with equities ever. There's no guaranteed payment at the end of the day. And this is particularly when you're talking about treasuries, which are guaranteed by the government. They have an implicit guarantee of payment by the US government that they will pay their treasury debt at points in the future. So when that bond matures, you're going to get your money back plus your interest payment. And that's why treasury bonds are considered to be risk-free rates. So when we talk about the risk-free rate in the market, that is the interest rate paid on US treasuries, because they're considered to have the very least amount of risk as long as the government was willing to pay you, right? So these are things we'll cover today, but the important thing to really understand about bonds is that they serve a very important purpose in your portfolio of capital preservation over time because they do mature at face value regardless of what's happening with the rest of the market.
Yeah, I think that's a really good start off and kind of segue into the environment that we're currently in. We've been in a long-term bull market for bonds, and now we've begun to see pressure on this. And I think that's causing a lot of unrest and uneasiness in regard to that, especially when every Fed speaker talks about we're fighting inflation, we're not going to back off, we're going to continue to QT, raise interest rates. I know you have a little bit different perspective as far as how long that can go on. And, what's the overall, so, we're getting a lot of questions on, where do you go right now in these volatile times with QT? How high can yields get? We actually talked about that this morning. And, where do you see people, if you're on the yield curve, where do you go?
Yeah. So, a couple of things. So first of all, there's this idea that if the Fed is reducing their balance sheet, that there's going to be no buyers of bonds out there. And that is absolutely not the case. The other side of this coin is that bonds in general are what's called a risk off asset. So equities are risk on, bonds are risk off. And historically, when the Fed begins to reduce their balance sheet, this becomes a risk-off environment for equities. Well, if I'm in a risk-off environment for equities, in other words, equities are declining, money's going to seek out the safest place for both a return of principal, capital preservation, and some type of return, and that's historically bonds. So if you go back to 2018 as a good example, during that period of quantitative tightening where the Fed was reducing their balance sheet in 2018, bonds had one of their best return years ever. Bonds did exceptionally well in protecting capital during March 2020 because money flows into treasuries looking for safety out of equity risk. So that's what's going to happen here as we move forward. But let's talk about the myth of QT. And there's lots of articles running around right now. It's like, oh my gosh, there's going to be nobody there to buy bonds, and that's absolutely not the case. First of all, let's talk about how QT works. Quantitative tightening works by the Fed just allowing bonds to mature, and they only replace a certain amount of them. So yes, the amount of bonds that the Fed is buying, the Fed's been buying $120 billion a month since March of 2020, but that was because the the government injected $5 trillion of new debt into the economy. So the Fed had to buy that debt. Now, at this point, the government's no longer injecting that type of capital. They're not having that type of deficit. In fact, the deficit is reducing sharply right now because of that liquidity that was spent in the economy is now filtered through the system. And now as those bonds mature, they won't need to be replaced because that money has been spent, it's been used, it's all down the road, and we're just hung with the excess debt. So as the Fed goes forward, and they're going to start by doing 60 billion in QE this month, and then they'll ramp that up to 90 billion in QE quantitative tightening and by August. So they'll look at their balance sheet. Now, the majority of the balance sheet over the last couple of years have been very short-term bonds, a lot of bills and a lot of shorter duration bonds because the Fed was doing this to bail out. In 2019, they were doing a lot of buying. There was kind of this private QE4 that was occurring in 2019 to bail out hedge funds. And that was a lot of short-term bills through the repo window. Then about 4 to 5 trillion of their balance sheet goes all the way back to 2008 when they were buying longer duration bonds for the original QE program. So those bonds are still on their books, and some of those are now coming due. So a lot of the maturities of those bonds that were bought in earlier years, if I bought a 10-year bond 5 years ago, it's only got 5 years left to maturity. If I bought it 7 years ago, it's only got 3 years left to maturity. So a lot of those bonds are now coming close to maturity. And so what will happen each month is the Fed will say, okay, this month we've got $100 billion worth of bonds maturing. So we're only going to replace 40 billion of them. And so next month they've got $100 billion more of maturities coming, and they're only going to replace 25 billion of them. And then of course, by the time we get to 90 billion, they're just replacing 10 billion. Some months, it's very possible that in some months we may see more than $100 billion worth of bonds maturing, and they actually have to go in and buy bonds to keep their balance sheet running at this kind of tapered set or reduction that they want to run it on. And then there's times they may have to actually go out and sell some because they don't have enough maturing. But the point is there's not going to be this massive dump of bonds, and then the Fed's just going to completely back out of the market. And there's going to be nobody there to buy bonds. That's just not the way the market works. And every single day, there is a tremendous amount of demand for U.S. Treasuries from foreign governments, and particularly now more than anything else because of what's happening in Russia, Ukraine, what's happening, in the rest of Europe right now. Money, sovereign funds, sovereign debt, sovereign money, foreign currency reserves are looking for a place where I can get a safe return of my money, and I can get a higher yield on my money than I'm getting elsewhere. And right now, because the dollar is strong, that is attracting a lot of inflows into the US dollar right now. And if I'm buying the US dollar, I have to convert my foreign currency into US Treasuries to hold it here. So again, foreign currency never leaves borders. Our dollar doesn't travel overseas. It converts to whatever other currency we're using it for, and whatever other country we're using, or vice versa. So if a foreign country, France, wants to put foreign reserves in the U.S., they have to buy the U.S. dollar, convert it to U.S. Treasuries. China is a great example of this, because what they do with the US dollar and with treasuries, and for a long time, everybody's like, oh, China owns all of our debt. Well, they own it for a reason. We do about 50 billion a year in transactions with China, imports and exports. And in order to keep currencies semi-stable between the two countries to make a beneficial relationship for trade, what China does is says, well, you just bought $10 billion worth of goods from me. I don't want that money coming back into the yuan, which will make our yuan stronger relative to the dollar. They buy treasuries with it, and that's what we call sanitizing transactions. So it keeps the currency level stable by them storing reserves into the U.S. Treasury. And so yes, they own a lot of our debt, but they own it for a reason, in order to keep that currency peg stable between the two countries.
Yeah, that's a great point, especially talking about the currency reserves. I think that's something that a lot of people, it's difficult to understand, especially when there's so many moving parts. When we think of bonds, for the most part, we think of when they raise the Fed funds rate, what's the impact going to be to the treasuries, right, therefore to everything else? When really we need to think about it from an economic standpoint of how long can this go? How high can rates actually get before they disrupt the economy? So I want to bring this back down just a tad bit. And Rich, you could jump in here. Let's talk a little bit about the difference between purchasing individual bonds, ETFs, mutual funds, closed-end funds. We're getting a lot of questions about people who own different types of instruments and how you would use them, or what type of bonds you would invest in at the moment.
I think you have to keep in mind, and bonds can be complicated. And to Lance's point, we've gotten to the point where we look at bonds on a gain loss, and we have seen nothing but rates go down. And to Lance's point, if we're going to go into a slower growth economy and our demographics pretty much, no other word but stink across the globe, then yields can only go so far. I don't know if you all seen what's going on in the mortgage markets, but even though sales are steady, we're seeing a real pullback overall in activity across the board, because people live off payments, people live off low interest rates. So there's only as much as you can go. I think the issue, Danny, is I think when we talk to clients about individual bonds, we tell them, don't worry about what they're doing, because if we're going to hold them to maturity, like Lance said, we're going to get our money back. But my gosh, the fixed income market's so fractal. I can buy ETFs, mutual funds, closed-end funds. I think, Lance, you always say it best when it comes to exchange traded funds, that obviously there is no maturity.
Right.
We are making in our portfolios, and you'll correct me if I'm wrong, we're making this estimated guess that, and an educated one, that we are going to slow down in the economy, and money is going to fly to quality, and there is going to be fear. So treasuries has always been, unless it's different this time, the place. And I hate to say it this way, but this is what I tell people, because we live in the United States and we don't realize, we think things are very disconnected here, right? We feel like, oh my gosh, what's going on? Inflation and the economy. Well, you know what? If this is a toilet, all the other countries are in the water, we're on the rim. Okay? Listen, we are the cleanest place for money. We are still the bastion of safety, right? Lance, money comes to us still. Yep. I don't know if that's ever going to change, but for now, that's the case. If you're buying ETFs, we have on the longer end of the curve because we think we're going to see appreciation in price. So you always say, and this is where I want you to share this with everybody, when you're buying a mutual fund or an ETF and there is no maturity, it's almost like you're making a yield bet.
No, you're absolutely right. This is the interesting thing about it. It's a great point, Rich, is that, we buy stocks and then we compare our stocks to the S&P index. And we say, okay, well, the index is going up, so I'm buying stock because I want to basically participate with the index. And that's all bonds are. And when you start buying an ETF, something that has no maturity date to it, you're not buying you have now stripped out the capital preservation point of buying bonds, right? So let me back up one step and I'll come back to this. We talked about this before. There's three things that you can have when you make any investment. You can have safety, you can have liquidity, or you can have return. But you can never have all three. You can only have two of three. So if I buy equities, I've got liquidity and I've got return, but I have no safety of principal. If I buy bonds, an actual bond, right? So I actually own the bond in my portfolio. I have safety and I have return, but I have no liquidity because I have to hold the bond until maturity. Cash gives you safety and liquidity, but no return. So no matter what investment, annuities, insurance, whatever, you can go through every asset class. No asset class will give you all three, but this is why you build a portfolio that has all three. You have equities, you have bonds, you have cash, and now you've got safety, liquidity, and return across the entire portfolio. That's proper allocation. But when we take an ETF, and so when you look at our bond portfolio that we run, where we have both individual bonds as well as ETFs, the individual bonds are the capital preservation portion. Those are going to mature at face value and give us an income return. I don't care what rates do. Again, if bond prices fall 30%, don't care because they're going to mature at face value. But the ETFs, that's a bet on the direction of interest rates. And that's all you're doing. Just like you buy stocks to bet on the market going higher, you're buying bond ETFs to either bet on interest rates going higher or lower. So your benchmark index for your bond market becomes the 10-year treasury rate. So that's my benchmark that I'm going to compare my ETFs to. And so if interest rates are either at a level now where I think they're going to go up, and this is kind of the interesting point of what's happening in markets right now, then if I think interest rates are going to go down, I want to buy bond ETFs because they'll go up in price. There's an inverse relationship between price and rates. If I think interest rates are going to continue to go up, I buy a short bond ETF that is going to bet on interest rates going up and bond prices going down. But it's simply a bet. You're just making a bet, and you're making a bet on two things. One, the direction of rates, and the duration. So if you think interest rates are going to be going lower, then I want to buy a longer duration ETF. I want to buy an ETF that has 10-year bonds and bonds with 10-year maturities in it because it'll participate more. They'll go up more in price if interest rates fall. If I have a very short duration bond ETF, I have an ETF that only has 1-year duration bonds in them, and interest rates go down, they're not going to move much because all those bonds are going to mature in 1 year. And so there's no participation really with the index itself. So, these are just things to think about. But the important point to Richard's point is that this is simply a bet on the direction of rates.
So Lance, let me ask you a question. I'm invested in my 401k and I see my bonds are not doing well, right? Because I'm looking by the red and the green. And by the way, when you look at gain loss, it's not looking at the income that investment's producing. It's going to look worse. But would you say I should, one, the short end of the curve, if this is a whip, the handle, that's the Fed, right? The Fed manipulates those rates. The long end, that's economic activity, right? Like you said, this is how bonds are gauging where economic activity is. If I wanted to think that, hey, I've got a Fed that has no idea what it's doing, shock, surprise. Janet Yellen just came out and realized that she was wrong about inflation. But you don't even have another hour to talk about what Janet Yellen's been doing wrong since she was Fed chair, which you wrote about and Mike wrote about ad nauseum, right? So can I barbell, or should I look at in my 401k right now, everybody that's on here, should I say, hey, I should look for a fund that has a low duration, where it'll be low in the name, short in the name, and then maybe long where I'm betting that the Fed will raise rates, but as they do that, economic growth is going to drop off. So I'm balancing this out, or what should I do as a 401k investor? And we're not helping people right now in the bond side, on the bond side of things.
It depends on your time frame, right? Mm-hmm. If you have, you're 2 or 3 years from retirement, then I would do exactly what Richard's saying. Like I'd have probably a majority, say I've got 40% of my 401k plan is in bonds. I would have 30% of that in the shorter duration bond portfolio, because they're not going to move up and down a whole lot, right? Because remember, I only have a couple of years to retirement. And then I have, a little bit on the longer end, intermediate duration bonds that if interest rates do fall over the next couple of years, which I suspect they will, you'll get a little bit of bang for your buck on the bond side as well. Now, if you've got a longer duration window, you say you're 10 years from retirement, I would backload your entire portfolio into long duration bonds. And here's why. We have just gone through the biggest drawdown in the bond market since 1788. So, if I just told you, now just step back for a second, let's talk about equities for a moment. If I had just told you, and you just woke up today and you didn't know anything was going on, and I just told you the market was down 70% from its peak and it just had the worst bear market in history, would you want to buy equities? Well, look at, in that environment, everybody's like, yeah, I'd buy everything I get my hands on, right? I can buy Apple at $10 a share. You bet, I'm going to buy it. And that's what just happened with bonds. Bonds just had this massive bear market. Now everybody expects bonds are just going to continue to go down and they're never coming back again. Throughout history, since 1788, every time that bond markets had this type of correction, the subsequent year returns were very positive. And this is going to be a function. Rich nailed this right, is that on the short end, the Fed's going to be hiking rates. And so it's like everybody's going, well, the Fed's hiking rates on the short end, so that means interest rates have to go up. No, not on the long end, because they're hiking rates on the short end, which is going to crimp credit card payments are going to go up, variable rate loans go up, auto loans go up. Everything on the short end is going to start to go up. You're going to see a contraction in spending. Longer term economic growth is going to decline. And when you get into that, either that decline in economic growth or that recession point, interest rates on the long end are going to fall. And what do we call that? Interest rates on the short end going up, long end coming down. That's an inverted yield curve. And that's what happens during a recession. So again, if I've got time, I want as much duration in my bond portfolio as I get. Now, unfortunately, for us managing client money and everything else, we have to be much more prudent about, how we manage risk. But if I had my dithers, I'd take everybody's portfolio and put it 100% long duration bonds and say, come see me in 2 years.
Well, you know what? And
they won't be happy for 2 years, but they'll be very happy at the end of 2 years.
Right, because the last time that word dithers was popular was probably 1788.
Yeah, exactly.
So you and I were pretty young then, but that is such an incredible point, because a lot of people will not buy when there's blood in the streets, whatever the asset class is, right?
Right.
So if I look at closed-end funds, what I'm really worried about for people, because I'm getting calls, I'm sure Danny is as well, and you are, oh my gosh, the yield on this closed-end fund is 8%. And I think people are going to get seduced by yield and understand that this is a sort of a wolf in lamb's clothing, where you got to really look under the surface with these things, don't you?
Oh yeah. Look, anything that pays you a yield that's higher than what the U.S. Treasury is paying you. And let's go back. We kind of opened this up talking about risk, right? And we talked about credit risk. We talked about interest rate risk, these type of things. So when you look at something, and again, Wall Street's great about marketing stuff, and they do this great. It's like, okay, if I called you up and say, Richard, I got a bond, and now I know this company's right on the verge of bankruptcy, but they want to borrow some money from you, and they're willing to pay you 9% to borrow the money. The first thing you're gonna think of is like, wait, did you say they're like really close to the verge of bankruptcy? And if I told you that, you wouldn't want to invest, you wouldn't loan them money, right? I mean, this is like your cousin Benny. You're from New York. It's like your cousin Benny showing up, hadn't have a job in 10 years, wants to borrow money. He's not going to pay you back. He'll probably loan you money, but he's not going to pay you back, right? But what Wall Street does, they call it high yield, because that's much better than junk or bankrupt bonds. Those don't sell as well. High yield sells really well. But when you look at a closed-end fund, you look at open-end funds, you look at ETFs, and if you look at anything that's got a really high yield on it, you've got to ask yourself, why? Why am I so privileged to get this higher yield than what I could get if I bought a US Treasury? Right now, US Treasuries are paying roughly about 2.8%, 2.85%. So if you're going to pay me 5 or 6, why am I so lucky? What's so beneficial to me that I get this higher rate? And that's, to Rich's point, look under the hood. A lot of these closed funds have a tremendous amount of leverage in them. And when the market blows up and people start liquidating assets to cover margin calls, these things get hammered price-wise. Now, if you can buy them at the bottom of the hammering, you're going to make a great amount of money. And there'll be some really good opportunity to buy distressed debt when we get into a bigger recessionary downturn, next year or whenever it occurs. But that's a different webinar we'll have on how to buy distressed debt.
You guys have answered a lot of really good questions here. And I think one question that we get quite a bit right now is, why would we hold them when interest rates have been rising? How high will they get? So like, for instance, we hold TLT, we hold individual bonds. We like those. But bonds have been beat up just as bad as stocks in a lot of instances. Where do you see this going? And why would you continue to hold in this environment and not sell?
Two things. One, you never know where the bottom is, right? And so if you own bond ETFs or bond funds, they're serving two purposes in your portfolio right now. The first thing that bonds do in your portfolio is they lower the overall beta volatility. And so let me just explain what that means. So, if you have 100%, okay, let me restate that. The average portfolio right now is down 30% for the year. Now, that's the average retail investor, 100% long equities. The S&P's down about 12, 13% for the year. They're down 30, right? And so, in fact, I just saw a portfolio from one of the big, they advertise everywhere. They rhyme with Swisher. I just saw one of their portfolios here lately down 50% this year, right? Just been absolutely crushed by this market. And so, there was 100% equity. If I had taken that portfolio and blended it with 40% bonds, right, and just bought an intermediate duration bond fund in that portfolio, the portfolio wouldn't be down 50%. The portfolio would be down probably 25 to 30% because of the benefit of lower volatility. I've got less exposure to equities. Yes, I've got some exposure to bonds, but bonds haven't fallen nearly as much as the market this year. So you have less volatility to the markets. And what that allows you to do is to weather your discipline, right? What's the biggest problem for all investors? They don't have an investment discipline to start with. And the first thing they do is start emotionally panicking when markets go down. So they start selling stuff at the bottom of the markets. They start doing all the wrong things. But by having a bit of your portfolio diversified into bonds, then it's got less volatility. You're not panicking as much. You can make a little bit better decision about where you invest capital. And when you look at our portfolio, our benchmark is the Barclays Aggregate Index. And so if you take a look at our duration versus that index, we're dramatically shorter. We have very little exposure right now relative. Out of our 40% bond exposure, we only have about 9% of that that's actually exposed to longer duration bonds. And we kind of mitigate that by having a lot of exposure on the very short end of the curve and treasury floating rate bonds that are hampering or tamping down a lot of that bond rate volatility. Well, that lowers the overall volatility of the portfolio. So during these market volatile times, investors can stay on track with their discipline to let the portfolio work and give yourself some opportunity. But that's also why we're holding 30% cash right now to further lower that volatility across the board.
Can you envision a scenario where we see we get into a recession, we have a bigger equity crash, and bond yields continue to rise or they don't come down?
Sure, anything's possible. And I don't want to ever say, because you asked me a question, can I see a scenario where this occurs? It's never happened, but you would have to have, about the only time in history that you could make a comparable kind of point to that would be 1974 during the black bear market that occurred. Interest rates had already spiked, though. The reason you were having the black bear market was because interest rates had already spiked off to the moon, and now Volcker's coming in to start reducing rates. but that was a very different environment. We don't have that type of economic environment today to support interest rates rising that much. Again, interest rates and inflation and economic growth and wages are all highly correlated with each other. And that's because wage growth is correlated to economic growth. Inflation is a function of economic growth. Interest rates are a function of inflation and economic growth, right? So if and this goes back to making a loan, if I'm a lender, right? So I'm gonna loan Danny some money. I've got to take a lot of factors into account. Okay, I'm gonna loan money, Danny wants to buy a house, so he wants a 30-year mortgage. So I'm gonna loan him money for 30 years. Well, I've got to take into account a few things. One, his credit risk, right? So is he gonna pay me back or not? He's a good guy, he'll pay me back. So all right, I'm good with that one. Well, what's inflation going to do? What are prices going to be like 5 years from now, 10 years from now, 20 years from now? Because remember, I'm loaning him money at a fixed rate. My interest rate doesn't float from one year to the next. I'm loaning Danny money for 30 years at a fixed rate. So I've got to have purchasing power parity of my dollars in the future. So if I look back and I go, okay, well, the average inflation rate for the last 30 years has been 2%. I've got to charge Danny at least 2% on my money if I assume that average inflation is going to hold true. If I think inflation is going to be higher over the next 30 years, I've got to charge Danny more money. So that inflation has a direct impact on the level of interest rates that are being charged. And then, of course, if I think economic growth is going to be really strong or robust, and I think there might be better opportunities in the future for me to invest that money, I might charge Danny a little bit more. Maybe I charge Danny 4% on his interest to cover inflation and opportunity costs and economic growth. So if economic growth is weakening and inflation is coming down, I'm having disinflation, interest rates are going to go down because they're a function of those two factors. So it's very difficult to have a disinflationary, deflationary environment, which you will have over the next 12 to 18 months, and have higher interest rates. They just don't historically work that way.
So explain something for like the individual bondholder. We look at a lot of individual bonds, and even in a good bond environment, many of these bonds were bought at premiums historically, which are coming down, getting closer to par value the closer they get to maturity. And I know a lot of people see that even in decent times and think, oh my goodness, what am I doing? Why are we in this asset that's losing? So maybe just explain a little bit of the difference between the coupon and the yield. And well, I think it's an important fact of bonds and how we look at them.
It's vastly important. And this is the one thing, if you're going to go out and buy bonds for your portfolio, you have to understand the differential between what's called yield to maturity and the coupon. The biggest mistake that investors make is they go buy a coupon. They go, and I get this all the time. I get people send me a bond portfolio. And they go, well, I have this bond portfolio that I built. I'm over at Schwab and I bought all their bonds yielding a 5% coupon. I'm making 5% on my money. I'm like, no, you're not. What do you mean you're not? I said, no, you're making 0.5% on your money because you paid premiums for all these bonds. Now, and I'm going to explain what that means. But when you buy a bond, and let's just start with this basic rule. When you call up the bond desk and you buy a bond, or let's say Danny buys a bond for you, right? You're one of Danny's clients and you say, Danny says, I bought a bond. Don't ask him what the coupon is. Ask him what yield to maturity is, because that's all that matters. The yield to maturity is the differential between the coupon payment and the premium or discount that you pay for a bond. Now, I need everybody to get out a pencil and paper and a calculator, because I'm going to explain exactly how the math works on this. Actually, I'm going to explain it, but you don't need pencil and paper. Let's assume I'm going to loan Danny money for 1 year, 12 months, at a 5% interest rate. At the end of 1 year, I'm going to loan him $1,000. So at the end of 1 year, Danny's going to pay me back $1,000 plus my 5% coupon, or $50. So my total return is $1,050. That's my principal and my $50 interest payment, or my 5% coupon. In that example, my yield to maturity is the same as the coupon, right? Because at maturity, I got a 5% payment. And so my coupon and my yield to maturity exact same. But let's say, for instance, that interest rates have gone up to, say, 6%. The value of that loan is now, why would I loan money to Danny at 5% when I can loan it to Richard for 6%, right? Because that's what the prevailing interest rate is. So in order for Danny to borrow money from me, I'm not going to loan him $1,000. I'm going to loan him $950. I'm just throwing out numbers, but follow along with me for a second. Danny says, well, I'm only getting 950. I was like, yeah, because I could loan $1,000 to Rich and he's going to give me 6%. You're only willing to pay me 5%. So I'm going to make up the differential on giving you less money up front. Now, this is buying a bond at a discount. Now, at maturity, Danny goes, wait a second. At maturity, I've got to pay you back $1,000 plus give you the $50 in interest. And I'm like, yeah, that's what you're going to do. And so Danny says, okay, so now I bought a bond at a discount and I'm going to get $1,000 at maturity plus my $50 in interest plus the $50 additional that Danny gave me for the difference between the $950 and the $1,000. So I'm actually going to get $100 at the end of the year on my $950 investment. So I'm actually making, over 10%. So it's actually a really good bond for me. So, but that's why yield to maturity is so important. If I bought it at a premium, if Danny, if I loaned Danny $1,050, he's only gonna pay me $1,000 at maturity, right? That $50 goes away. He's still gonna give me $50 in interest. My return is now 0. So that was a 0 coupon bond because I bought it at maturity. What yield to maturity tells you, no matter how you run the math, premium, discount, face value, the coupon tells you nothing. It just tells you what the stated coupon rate is. What is important is that yield to maturity, because that's what tells you at the end of the day, when that bond matures, exactly what you're going to get back. As I said when we first started this out, the beautiful thing about bonds is the moment I make Danny that loan, I can calculate to the penny exactly what I'm going to get back. And you can't do that with any other instrument. And so, yes, it may go up or down in value. If you buy a bond at a premium, it's going to fall to face value. So the whole time you own that bond, it's going to be losing value. And you're like, look at your statement. You're like, oh my gosh, I'm just losing money in all these bonds. Nope, you've already been paid for it and you're going to get it back. And it was all stated in that yield to maturity. So as long as you were happy when you either went online and bought the bond or Danny called you up and says, hey, I've got a bond. Its yield to maturity is 3.5%. And you go, hey, I'm happy with that. That's great. I get 3.5% of my money for the next year, whatever. I'm happy, right? Be happy. It's like a CD. It's going to pay you maturity plus your interest and you on down the road. Don't worry about what's on your statement. That's where it creates all of these other emotional problems where we make bad decisions.
You also, I think, Lance, you got to remember bonds get called sometimes before maturity. So you got to look at yield to call, yield to worst, right? You got to look at what net is going to be in your pocket. And some bonds are not going to be worth paying for. Now, I just got a couple of questions for you, sort of piggybacks off Danny. One is bonds and stocks have sort of started to move together in the beginning of the year. And that made things disconcerting because it really had no place to hide except cash. Now we're starting to see when stocks go down, bonds go up. In other words, bonds are looking like they're doing what they're supposed to do. But can you explain when that happens as far as, oh my gosh, my bonds, yeah, they may not be falling as much as my stocks, but they're not providing me really any downside protection. And I think that's where people go, oh my gosh, bonds are not working, stocks are not working. What's working?
Well, it's interesting because this year it got everybody's attention because bonds fell a whole lot more than normal. But up until 2000, from 1900 to 2000, I did a study on this a while back and we wrote an article about it. But from 1900 to 2000, the bond market and the stock market had a non-corollary relationship. So in a year that stocks were up, bonds were down and vice versa. And it was very regular. It was very easy to see that non-corollary relationship work. When the Fed became active starting in 2000, that correlation went to 1. And basically stocks and bonds have been running together ever since then. Now, the difference is that when asset prices were rising, for the most part, bonds were also, interest rates were going up at the same time. And so bond prices falling, but they weren't falling that much. Interest rates weren't having these very big moves very quickly because interest rates were a lot higher. It's hard to believe, back in 2000, we were talking about 8% CDs, right? In 2008, we were at 4.5% on treasury yield. So you go to 4.5 to 5, on interest rates on a move up. that's a half point move. It's fairly big, but relative to 4.5%, it's not that big of a percentage move. But when you're going from 0.5% in interest rates to 1% in interest rates on 10-year Treasury, that's 100% move, 100% increase in the value of interest rates. So it seems a lot more dramatic now because of the very low rate environment we were post 2020, but the non-corollary efficiency of bonds versus stocks has really been eroded a lot by the Fed intervening into markets. Now, where these bonds become detached and we get that non-corollary effect up, back into the marketplace is when the Fed starts doing quantitative tightening, which they're starting now. So this is why I think you're starting to see that non-corollary effect between stocks and bonds starting to come back into play. And I think you'll see that, and it's not going to be perfect all the time. It's never one-to-one. But I think you'll start to see this deviation of stocks and bonds from being so correlated like we saw earlier this year.
It sounds and it feels so counterintuitive, Lance, when you think about, what's going on economically. We are beginning to see things slow down, yet we're seeing higher inflation. People are feeling it at the pump, at the grocery store. And then, talking about non-correlated, when you think about quantitative tightening, everybody thinks that automatically rates just begin to increase, especially on that longer end of the curve. And, when in actuality, we should see, margins begin to become depressed more, corporations hurt more, which would then inevitably lead to, which does feel counterproductive, seeing yields drop back down. Now, you mentioned this morning, we were talking on our investment call about looking from a technical perspective, that looking back, you guys looked back 12 different times just recently, in the most recent 12 times in this type of environment. And we can't find an environment really, except for the one you mentioned, where we've seen rates increase substantially.
Mm-hmm. Yeah, no, and that's right. I mean, history just, again, from just a technical viewpoint and just a variety of other things, if you go back, and I've posted this chart before, at different times, but there's never a point to where interest rates are trading at 4 standard deviations, against technical mumbo jumbo, but 4 standard deviations above, their long-term monthly means, that you didn't have a recession, a financial crisis of some sort, or a stock market crash of some type, right? A deep bear market. And we're currently well into that 4 standard deviation territory on a monthly basis. And that's just a function of where we are. We're also at the top of the long-term downtrend line that we've had in interest rates. Every time interest rates have risen to this level in a long-term downtrend, that's been kind of the peak of that move in interest rates. And so technically there's a lot of support right now suggesting that we've likely either have seen the peak in rates or very close to seeing the peak in rates. It doesn't mean that in the short term, and we're having this conversation today, and it doesn't mean right now that over the next week or 2 or 3, we might see rates pop back up because of something the Fed says or something that happens overseas. Certainly the case, but I think what we're going to see over the course of the next several months, and this is really kind of the positioning we're taking in our portfolios right now, is over the next several months and into next year, that rates are going to start working themselves lower. It may not be a dramatic turn, but once rates start, when we actually realize the economy's in a recession, or there's some dislocation in the credit market, or we realize the Fed's broken something, interest rates will fall very quickly, and they'll go from 2.5 to 0.5%, literally what'll feel like almost overnight. And that's why you've got to be positioned in advance. By the time you realize that the move in interest rates is on, it'll be over, because if you go back to 2020 and look at that turn in rates, that drop to 0.5% happened in days, not months, not weeks, literally a function of days. Interest rates almost went to zero. So, and that's what will happen in this next downturn. I suspect we'll see 10-year Treasury rates at zero.
We get a lot of talk about, this is the 70s again. Yeah. It feels 70-ish, right? I even have a whip inflation now button that I wear on the radio show.
Yep.
But there are some very, very, very important structural differences between today and then. And I think if you shared that with the audience, that'll also show you why rates cannot go to where they would. And if they did, where would our economy be based on the structural breakage we've got right now? And it's not just here, right? It's globally.
It is global. So back in the 60s and 70s, you got to remember that we were a manufacturing driven society. So we had just come out of World War II, and, Johnny came marching home and we didn't have anything, right? We had spent everything on the war effort. So all these people came back home and they started building businesses and roads and factories, and people got to work. They were having babies and building houses and doing all these things, right? And then we got into the space race, and we're just everybody is in manufacturing. There was, service was a very small percentage of the economy. About 80% of the economy was manufacturing based. And so when you have a manufacturing base of 80% of the economy, that's what we call a very high multiplier effect. And what does that mean? So if I'm going to build something, right, I'm going to build a house. Well, a house has a very high multiplier effect in the economy because I've got to go buy the lumber from the lumber supplier, who has to buy the trees from the lumberjack, who has to then mill it and then transport it to the lumber company, who shaves it down, makes the lumber. I've got to go to the sheetrock company. I've got to buy sheetrock from them. Of course, they had to go buy the gypsum and everything else that went into sheetrock from the companies that mine that. And so this is creating jobs and activity all through the economy. And think about everything that goes into a house, right? Carpet, furniture, architecture, electricity, water, plumbing, all that, right? So all that stuff that goes into building a single house has these vast tentacles throughout the economy. And I think we're doing this on everything. We're manufacturing TVs and rocket ships and planes and blue jeans and everything else, because we were all manufacturing it here in the US because we had bombed all of Europe to oblivion. So they didn't have the ability to manufacture. So we're the manufacturing epicenter of the world, right? Everybody's working. And here's the really cool thing. Nobody had any debt other than their mortgage. The average debt to income for households was about 60% of debt to income, right? So very manageable, very affordable. My parents didn't have a credit card. They didn't believe in credit cards. They paid cash. They went and bought a car for cash. Of course, a car was $3,000 back then. Their house was very modest, but back then that was normal. Everybody lived in 1,200 square foot houses, 3 bedrooms, 1.5 bath. That was the McMansion back then, and then the 1980s come along and Ronald Reagan decides to deregulate the financial industry, right? And so now all of a sudden we go into financial weaponization of debt over the next 30 years. We rack up massive amounts of credit card debt. We tell consumers they can live well beyond their means. They can buy bigger and bigger houses because we can do it with lower and lower rates. And we did all these things. The difference today versus what we had back in the 1970s is today we're an 80% service-based society, which has a very low multiplier effect. If I go get an Uber driver to drive me around, I pay him, he pays the gas station. That's about the function of all the impact to the economy. It's got a very low multiplier effect. Government spending has a negative multiplier effect in the economy because recycling tax dollars doesn't create growth at all. And then, of course, on the other side of this, the debt structure is now completely inverted. The average debt to equity for households is about 140, 150% of debt to incomes. So just completely backwards. Consumers are having to live further and further into credit just to make ends meet. And the only way they can afford to do this, and to Richard's point, this was a long way to get to this point. The only way the consumer, which is 70% of the economy, can continue to drive economic growth is they have to do it on debt. And they have to have lower and lower interest rates in order to borrow more money. So as soon as interest rates start going up substantially at all, you pop the debt bubble across the board. Look, we're already seeing it with housing. You'll see it with credit cards. You'll see bankruptcies go up. You're already starting to see the number of zombie companies come down. These are companies that depend on low interest rates in order to survive. All that's going to reverse. So the longer that interest rates stay at 3% or anywhere higher, the more risk you take in destroying that credit bubble within the economy.
Not only that, what's the debt to GDP ratio for the country and other countries? What was our debt to GDP in the 70s?
I don't know the exact number, but our debt
was
to
like
GDP
30%, 30% debt to GDP, something.
It was very low, and we had no deficit, right? In the 70s, there was zero deficit. Today we're running a $3 trillion deficit, and we've got 30 trillion in debt. Our debt to GDP right now is running roughly 130%. It's projected to be 230% by 2050. So basically, welcome to Japan.
So it's like you said, rates can only go so far before you collapse the whole thing. And we have to remember there's a baby dearth. We're not, the demographics across the globe, we need babies for economic growth, and we don't have that either. So there are a lot of structural changes that do not warrant rates to be anywhere near where they were in
Right.
the
Well,
70s, even though you might be getting glimpses of a nightmare of, when it comes to gas, and now we're going to Saudi, we're going to OPEC again, and it does feel a little bit 70-ish there, but too many structural issues to get to a.
Yeah, and again, you kind of look at kind of how this, this all functions is that, ultimately, we talk about Japan, right? Japan has 230% of debt to GDP, and they're still alive, right? It's, we always talk about Japan being kind of the bug in search of a windshield, but they haven't hit it yet. But also, if you take a look at Japan, they've got very limited economic growth. They have a recession about every 3 years. If you're a youth in Japan, your life is terrible. I mean, it's hard to get work. People can't have relationships because they don't have jobs. They live with their families, and it's not a great economy. And interest rates can't get off of zero. Their interest rates in Japan remain at zero almost all the time. And as soon as interest rates tick up at all, they have a recession. But that's because of all that debt they have sitting on top of their economy. And that's what we'll eventually face here. And this is why interest rates ultimately will get suppressed lower, because anytime interest rates move up, it impacts the debt. And the more debt we keep laying on, we're at 30 trillion plus right now. We're going to be at 35 trillion, 40 trillion. It just, when we get there, it's inevitable. The CBO just came out with their report. It ain't pretty where we're going to be in the next 20 years in terms of debt. That just means that interest rates can't go up. You're going to see quicker cycles. We were very fortunate between 2000 and really between 1990 and 2008, we were very fortunate because you had this tailwind of declining interest rates, declining inflation, lots of liquidity, and that helped expand that business cycle. But as you get closer and closer to zero with a lot of debt, you have more recessions more frequently.
Well, you've been writing about this for a while, and we don't know when recession's coming, but I just checked the Atlanta Fed GDP now as of yesterday.
Yeah.
The growth, it went from 1.9% for the quarter down to 1.3%. So
right.
we're falling more and more as rates go up, and rates don't have to go up that much. Right now in real time, it's proving your point.
Right. Well, look, and don't forget. Yeah, and don't forget, first quarter was negative 1.4. So you take negative 1.4 and 1.3, you're zero. So, for 2 quarters. So now that's annualized rates of return, right? But that's not very much growth for 2 quarters, and that's probably going to get weaker as we move out to the rest of this year.
So Lance, kind of closing thoughts. I know we're about to shut it down. We try to keep these right at an hour. And hey, thank you guys so much for all of your questions. I know we've answered a lot of them in roundabout ways with lots of different information. But what would you say in part about bonds? Just trying to close this down.
Bonds are a very important part of your investment strategy and your investment portfolio. They serve more than one function. It's not just a function of I'm buying a bond for a coupon. They serve a lot of functions. And as with any good asset allocation model, and we talk about this a lot, people, they talk bad about annuities because all they've heard is bad things about annuities, or they don't like life insurance because they heard Dave Ramsey talk bad about life insurance. All these instruments are great, right? They're all really good instruments. If you misuse them, right, you use them incorrectly, they will hurt you. But if you use the tool properly, they can be very beneficial for you. So it's just important to understand, if you're going to use bonds, understand why you're buying them, what the effect is going to be on your portfolio, and understand the dynamics surrounding how that money is going to come back to you. Because again, it's all about return at the end of the day. With stocks, I know I buy a stock and I just kind of hope it goes up. And if it goes up, great, I make money. And then I don't sell it until it turns back into a loss. And then I sell it at a loss. You know how that game works. But with bonds, why am I buying the bond? I'm buying the bond to give me capital preservation. I want a return on my money, and I want my money back at maturity. And I'm okay if I just get 3% a year. I'm happy with that because that's what it's going to do for me. And I understand what that part of my portfolio is doing. I understand my real estate's doing for me. I understand what my equities are doing for me. And by building a good asset allocation model, you can control risk and have a better total return over time.
No, I think that's great. And hey, guys, if you guys have any more in-depth questions or you feel like we didn't answer anything, don't hesitate. Go to realinvestmentadvice.com. Go to Ask the Question. We'll happily answer any of those that you may have. Also, if you're a client and you say, you know what, this was great, but I want a little bit more information, don't hesitate to reach out to your advisor if you've not spoken with them already. We're happy to address any of these questions, go in depth, talk a little bit more about portfolios and what that means to you and your money. We know it's extremely important to you guys, which is why we're trying to get out and talk about these things. Because look, I know it's been volatile. It has not been fun, but I'm optimistic. I think there's a lot of opportunities on the horizon. I know Lance is. I think we're going to be able to sift through the rubble of many different asset classes and find lots of great deals. But hey, remember, none of these things here today were specific recommendations. If you do have a question, don't hesitate to reach out. Thank you guys so much for joining us today. We are RIA Advisors. We'll see you soon.